Good evening, everyone. Uh, Now we'll start lesson 9, which is working capital. And this is also fifth unit, last unit of the syllabus. After this, we have a couple of more chapters to finish this. Working capital, we'll discuss about meaning, concept, working capital cycle, types of working capital, determinants, and estimation. What do you mean by working capital? It is the capital required for the day to day working of the organization. So, it is the capital which is required in the day to day working. Now, it refers to the funds required to carry on the day to day operating activities of the organization. There are various concepts of working capital. If you look at balance sheet concepts, gross working capital and net working capital, and circular flow concept, gross operating cycle and net operating cycle. What is balance sheet concept? When we talk about what do you mean by gross working capital, it is investments into current assets. So it is equal to current asset when we look into balance sheet. And what is net working capital? Net working capital is current assets minus current liabilities. So it is current asset on top of current liabilities, whatever it is. Now let us go for gross operating cycle. We'll understand this when we'll understand operating cycle method. So we'll understand gross operating cycle and not net operating cycle when we'll understand operating cycle method of working capital. Now this is operating cycle, working capital cycle. If you look into this, we from cash we buy raw materials, we pay wages, we pay all expenses, we make stock, then it goes for work in progress, finished goods, then we get sales out of it, debtors, and debtors again convert into cash. This whole cycle is known as operating cycle or working capital cycle. Now, if you look into this cycle, what happens is once cash goes into raw materials, wages, expenses, you will not get your cash unless and until debtors pay you off. So your cash get blocked for this whole cycle. Now, for how many days will it be blocked? Will be sum of raw material days, work in progress days, finished good days, debtors days, and also it will be you will have to deduct creditor days from this. Now, number of days of inventory is inventory divided by average days cost of goods sold is equal to 365 divided by inventory turnover. So what is inventory turnover? Inventory turnover is average days cost of goods sold divided by inventory. Similarly, number of days of receivables, it is average days of receivables divided by average days revenue, or it is also equal to 365 divided by receivables turnover. What is receivables turnover? It is average days revenue divided by receivables. Number of days of payables, it is accounts payable divided by average days purchase, which is equal to 365 divided by accounts payable turnover. Accounts payable turnover is what? Average days purchases divided by accounts payable. Now, what do you mean by a number of days of inventory? It means average time it takes to create and sell inventory. What do you mean by number of days of receivables? It is average time it takes to collect on account receivables. Number of days of payables, average time it takes to pay its suppliers. What is operating cycle? It is number of days of inventory plus number of days of receivables. And what is a net operating cycle or cash conversion cycle? It is known as number of days of inventory plus number of days of receivables minus number of days payable. So if we go to the previous slide, what is gross operating cycle? Gross operating cycle is same as operating cycle mentioned here, number of days of inventory plus number of days of receivable. And if you want to find out net operating cycle, it is number of days of inventory plus number of days of receivables minus number of days of payable. Net operating cycle or cash conversion cycle. Now, types of working capital. On the basis of concept, there are two: gross working capital and net working capital. On the basis of time, temporary working capital and permanent working capital. Permanent working capital are of two types: regular working capital and reserve working capital. And temporary working capital are of two: seasonal working capital and special working capital. What are the determinants of working capital? Nature of business, nature of demand of the product, production policy, because all depends on production policy, what kind of working capital is required for the day-to-day activities. Then credit policy, if you're getting good from creditors, you good days from creditors to pay back your debts, then you will need less of money, less of working capital. And if you're getting if you're getting less number of days from your creditors, you will need more of days for working capital. And dividend policy, if you pay more of cash into dividend, then you will have less for working capital. Working capital cycle, if your working capital cycle is of more days, you will need more money for more period of time. And if your working capital cycle is of lesser days, you will need working capital for less time and of less amount. Manufacturing cycle, business cycle, price level changes. Inflation also guides the requirement of working capital. In case of higher inflation, you'll need more money, things are expensive, you will need no more working capital. Effects of external business environment factors. In case the external business environment factors are not going in a positive manner, you will need more money to get, because you will get less of credit period from your creditors, and you will have to give more credit period to your debtors so that they can return money on time later, and thus you can boost your sales. And for that you will need more of your working capital. How to estimate working capital? Working estimation can be done through 4 methods. Working capital as a percentage of net sales. In this, simply 20%, 25% of net sales is gross working capital, and 20% of net sales is net working capital. Working capital as a percentage of total assets or fixed assets. So whatever assets we have, total assets we have, we take working capital as a percentage of that. Projected balance sheet method, we make projected balance sheet, and whatever cash requirement comes, we take that part as a working capital. And adjusted profit and loss account, we try to find out the revenue and the expenses, and whatever expenses are there which is not covered by the revenue has to be brought and has to be taken as working capital. Now, advantage of adequate working capital: if you have adequate working capital, you will get good cash discounts. You can create a feeling of security and confidence within yourself. Must for maintaining solvency and continuing production. It makes your goodwill on a better way in the market, and it also gives you debt capacity. Easy loan from the banks, because you have good working capital, you've already invested in your current assets, you will get good money from bank. Distribution of dividend will be easier for you. Exploitation of good opportunity, because you have enough of working capital, you can grab as many of opportunities as you can. Meeting unseen contingency, so you can, if any, in case any contingency come, you can easily meet that. High morale, your morale will be high because you have adequate working capital. Increased production efficiency because of increased working capital. So these are the advantages of adequate working capital. And disadvantages of having excessive working capital: heavy investment in fixed assets. So in case you are if you invest more of your amount in working capital, then you will not be able to invest in your fixed assets, and you will not be able to expand your capacity, and just like that you're keeping more of raw material with you and you are not able to use it, so it leads to wastage of funds. Reckless purchase of material: it just because you have a lot of money, you just keep on purchasing things and without giving brain to it. Speculative tendencies: if you have more of working capital, you involve yourself into speculative trading, where you try to make quick money in less time. And liberal credit, also excessive working capital makes you give your money in liberal terms and conditions, and that may lead to a lot of NPAs and lead to a lot of loss of money and carelessness. A lot of money means a lot of carelessness. So if you have excessive working capital, it is very important. If you have working capital, it is very important to manage it properly. If you don't deal it with properly, then it will lead to a loss of funds. So with this we come to end of the ninth one. We'll again discuss about some of the things here. If you look into this slide, gross working capital is investment into current assets, net working capital is current asset minus current liabilities, permanent working capital is a part of working capital which is permanently invested into it, and temporary working capital is additional working capital which you have to invest into working capital, part of the fund which is you have to invest into working capital for a certain period because of certain rise. For example, in case of umbrella business, during rainy season you'll have to invest more of working capital, and rest of the seasons it will remain dry. So this is on the basis of time. If you look into this again, the slide, you cash, from cash you buy raw materials, wages, expenses you pay, and you have stock, work in progress, finished goods, revenue, and debtors. So this, and from debtors you get the cash. So thanks for the time. I hope you all enjoy the session. We'll go for 10th chapter, which is management of working capital, in our next video. Thank you for the time being. Thank you.